We've reached October, and returns this year have been spooky. It's one of those situations where you're probably sitting back and wondering if you still have the right strategy and if you should do something about it. It's a common feeling in markets of this nature when you see declines and you see red numbers on statements. It can make you feel a certain way, almost like a retirement horror story. That's what we're diving into today. This is the Financial Symmetry Show. Welcome back. I'm Chad Smith here with Allison Berger this week, and we're tackling an idea that it might have bitten several people in the past on their journey to retirement, but we put together a fun example. We call it a fun example. You know, every October we kind of go through these. We might pick a pop culture reference to use as a real life example and talk through some decisions that could have been made in the past from a real individual, a real investor. And then we want to talk through a way that, you know, things might look a little bit different if it didn't go that way. So let's dive in and start thinking through some of this and how it might impact our listeners.
Sure. So as you mentioned, it's been a little bit of a spooky year for the stock market. And with Halloween approaching, we wanted to do something a little bit fun here. And we've gone back and sort of recreated an investment journey based on a fictional horror movie character. So with Halloween coming up, it came to my attention that the Halloween movie franchise is also coming to an end. And Halloween Ends will be released in just a few days. If you're listening, it probably was just released. And in looking at this, incidentally, the fictional character of the murderous villain Micheal Myers would be turning 65 this year. So we thought it'd be fun to think about what his investment journey might have been like and his retirement plans, because we're assuming maybe he doesn't want to be in the murder business forever. He wanted to have an exit strategy. This looks like this will be the last movie, but we will see. He has a habit of coming back from the dead. And on Wikipedia, they actually call the Halloween movies a choose your own adventure sort of horror movie franchise. It goes in a lot of different directions. We're going to go in a few different directions today. So if you will, just give us a little bit of artistic liberties as we talk about his investment journey through the years.
I'm not sure that Micheal Myers wants to retire to anything else. That's been his passion his entire life, yeah. Right? Of searching out and trying to provide some mayhem in lives. But as we dig into this, I want to first start and allow our listeners to go to our website and download our market guide to volatility, right? To deal with some of those things. If you haven't yet, you can just type "Stay in the Course" in our search box on financialsymmetry.com and find that. You can download our ebook. We've got a lot of good information there of different articles we've written on a serious note of how to deal with market declines and how you can best approach it in your retirement journey. Because the reality is we all have a desire to predict the future and try to control our investment journey to the extent we can. And those desires shift and change with the winds of the economy. So let's dive in here, Allison, to Micheal's plan and how his investment journey played out.
Yes. So let's assume, Micheal Myers, the first movie came out in 1978. Let's assume he's a young man at that point, and he's going to start his investment journey at age 25, a few years after, finding a little bit of success in his villain career, and maybe he's even got a side hustle that he's earning some extra money. So we're going to assume that he's saving some cash at the bank throughout the year, and every year around the holidays, he's taken 2 weeks off and he's reading some Money Magazine and Fortune and deciding if he's going to invest the next calendar year, what he's going to invest in, and how much he's going to contribute. Some years he's going to sit out of the investment game and keep his money in cash at the bank. Some years he's going to decide to enjoy himself and maybe take a vacation or treat himself to some new weapons instead of saving and investing. And then, he wants to pick individual stocks. After all, this is a character who comes back from the dead multiple times, so he likes to take his chances. He's not really looking to be a diversified investor. He wants to take a little bit more risk than that and try to pick the next winner. Most of his stock picks are coming on a whim, based on what he's reading in Money Magazine, Fortune, or tips he's picking up at cocktail parties with his buddies. So we're starting out here in 1982, and as you can imagine, like some other serial killers, he likes to keep a little memento. So what he decides to invest in on his first trial here is Kodak. You could take a little picture of things that you might want to remember. So the first year goes great. In 1982, he returns 20.91% on his initial investment. So he's riding on the success of the recently released Halloween 3, Season of the Witch. And he decides that went great. I'm going to put, another 10,000 into Kodak. That first year he put in 2,400. He'd saved up 200 a month throughout the year, and he's earning some money in his films here. He wants to put another 10,000 in. So that second year, 1983, doesn't go quite so well. The company loses 11.5% on its stock. No matter, he's still feeling good about it. So he's going to put a little bit less in. Let me go back to that 2,400, 200 a month plan. Third year, another disappointing year with a negative 5.5% loss. So I think Michael's taking a break now. Time to take a break, regroup, sit things out and cash at the bank for a little while plotting my next moves and hopefully hoping for another movie deal. So over the years, Chad, you've got a comment there?
As we move through this, we're going to have a couple different examples. It might be, if you're just listening to it, it might be harder to follow, but we'll have a graph in our YouTube portion that you can see the differences in how this looks over time.
In the show notes, we'll have a little more details, but I think this pattern might sound familiar to a few folks, that maybe you've taken similar actions, or maybe you know friends or family who have taken similar actions in. When I think about Micheal Myers, I think about chasing. So thinking about that, chasing your next victim or chasing the next hot stock, that's what we're talking about today, and kind of following that cycle of fear and greed, or fear of missing out, if you will. So while the horror movies are about fear, investing can be very driven by fear as well. So over the years, we see Michael following a similar pattern of buying a stock, holding it for a few years, and then sitting the next few years out. That fear and greed that we're seeing many investors experience. Over the years, he has some great picks and some winners he's able to, boast about to his friends at cocktail parties. Among them, he earns 39% in Compaq, which is changed over to HP. He earns that in 1987, has some really hot investment returns in the 1990s, 18% on Starbucks in 1 year. He managed to sit out the 2008 financial crisis, even got in on the excitement of Netflix, liked the movie theme there, that they were going digital with the movie business, earned nearly 300% on that stock in 1 year. After jumping from his high earnings in Netflix, he moves over to Tesla, which produced some enviable, followed by disappointing results. Takes one more break. This is getting us to about 2020. He just has a few years left to retirement. So he takes a break from investing and then decides, I only have a few years before retirement. It's time to make up some ground, really start saving more. I'm putting my money in Bitcoin. So puts the money in Bitcoin there. We're seeing that ride. He's picking all the winners over these years, right?
Well, that's one of the things that can tend to color your investment journey. It's a lot easier to remember the winners, the things that are doing well, feeling good about those things and wanting to invest more in those things. It's a common behavior we all experience, right? That's part of kind of our instinct, is to want to move to things that are doing well. And that's what can make investing so difficult, right? But it's important to try to talk about some of the mistakes and remember those mistakes and think about and learn from those. So let's talk about a little of the low points of Michael's journey here.
Yeah, so there were some low points along the way. And among them, obviously he experienced Black Monday, the savings and loan crisis, Y2K, the dot-com bubble and crash, Hurricane Katrina happened during this time frame, subprime mortgage crisis, Brexit, COVID-19 pandemic. He did have some years where he had losses in Amazon, Netflix, Bitcoin. And he, we mentioned that he sat out the 2009 bear market. However, he missed out on some major stock advances in some of those years that he was sitting in cash at the bank, 1985, 2009, and 2019 among them. I picked these fairly randomly because I wanted to follow a random pattern and follow that theme of, every 2 to 3 years, finding something that was a recent winner, maybe having a year or two of gains in that, and then changing course and picking something else. So this was intentionally sporadic and random. And some of his sentiments during that time, you can imagine, are ones that we hear from investors along the way, like, I'm not throwing any more good money after bad, or maybe I should try this again. Not doing that again, I learned my lesson. And then, that was a wild ride. I should take my profits now and get out while the getting's good. Not hanging around to lose any more money. The stock market's been killing it, and I need to make up some ground. We hear that sometimes. And then finally, that's it. I'm staying out of the market. I can't gamble with my retirement money.
It's incredibly difficult to separate the emotional impact of the FOMOs, right? Of the fear of missing out, or the fear that you're going to lose it all when things are moving in the wrong direction. And in many cases, that can start to control, certainly influence, and often control your decision-making process about what you should be investing in, how you should be changing course, and what should you be doing. Because it generally feels better if you're doing something about a negative experience that's happening to you in the markets. So that's where, a financial advisor sometimes can come in and help you implement a disciplined approach. So we as you might imagine, have compared to a disciplined approach. You might want to see the first results first, though.
Sure. So in total, Micheal Myers in his investing career, he put away $226,400. So that's how much he invested or he put into those accounts. By sort of using his sporadic investments over the years, choosing these individual companies and sitting some years out in cash at the bank, his final value in October of 2022 is about $243,275. So it's more than he put in, right? It's higher than he put in. However, and again, artistic liberties, because we're comparing that to if he had just sat in cash at the bank the whole time, what would those results have looked like? And if he had just sat in cash at the bank and let's say, generously he earned 2% on that money over time at the bank. And we know some years it was higher than that, some years it was lower. We're going to say on average it was about 2%. Then his final nest egg would have been about $316,471. So it sounded like a pretty stressful investment experience to me, looking through, all that he went through, trying to choose these individual companies, figure out which one was going to be the next winner, have some very high highs and some very low lows to end up with less than you would have had you sat in cash at the bank. And unfortunately, what we know is going to happen is even that cash at the bank, inflation's usually running 3%, you're losing purchasing power over this time. So unfortunately, that nest egg is going to fall victim to another horror movie villain, Hannibal Lecter, and it's going to be cannibalized by inflation.
So it sounds like Micheal did not have much of a plan when he was making his investment decisions along the way. So if he had reached his breaking point and said, man, I thought I'd have more by now, kind of came to his senses and wanted to sit down and put together a plan at this point, what would be some of the outcomes that he'd be looking at from here going forward throughout retirement?
Well, I think with Micheal, first of all, I'd probably propose a virtual meeting would be my preference to look at his financial plan together. But most likely, we don't know a lot about his expenses. We don't have all the pieces. We need to pull those pieces together. But just based on this final nest egg, $243,000, assuming he's going to live 30 more years, we don't know what his Social Security income, whether he has a pension from the film industry. However, just looking at these numbers today, I would say it's likely he's probably going to need to make some difficult decisions. So that might mean working longer, spending less than planned, maybe downsizing his house, relying on support from children or other family members. Don't know if those relationships are salvageable at this point, or maybe even relying on a reverse mortgage.
Yeah, you wonder if Micheal had a number in mind and if he really reached that number. But I'm sure he could be a little frustrated with how that investment journey and experience went through the years. So that's why we have taken our liberties here and said, well, what if? What if 15 years ago he had reached an epiphany after going through a very difficult experience through the 2000 decline, right? What if he had gone through that, the technology bubble, and had some of those investments burst, and he was sitting in cash and thinking, man, I'm just sitting here doing nothing. It's not earning anything for me. I really need some help. And he went and got a plan completed at that point. Let's talk about how that investment portfolio strategy might look for him if he would have done that at that time.
Yeah, so at age 50, he's adopts a self-improvement plan, and he's committed to making the changes that he needs to make to get his retirement on track. So at that point at age 50, let's assume he maxed out his 401k every year. He invested in a globally diversified portfolio of stocks, didn't make any investment changes during that time. So he just invested in the same thing January 1st of every year. If he made those changes in his situation at age 65 today, his nest egg could be over $900,000, even with the recent market downturn that we've been experiencing here, which this is, a significant improvement from that 243,000 that we saw in the prior illustration, with kind of making those movements in and out of the market, trying to avoid losses and pick the next best winners.
Yeah, so the self-improvement plan, he's putting together that plan, and that's a significant difference there, right? But what did that require? What are some of the ideas and thoughts he might have had in that journey versus the journey that he chose in the first example?
Yeah, so I think in terms of the lessons learned from the prior examples is one, diversification. So not putting all your eggs in one basket. Companies can go through a lot of different changes over time. There can be things that cause performance to fluctuate very wildly. You're going to experience a lot of fluctuation with investing. However, that can be smoothed out over time by diversifying across, we would say globally diversified portfolio, thousands of different companies across the globe, so that you're benefiting really from the progress that happens over time. All those companies creating value for their employees, their shareholders, and their customers. And thinking twice about chasing the biggest stocks. We see with chasing, there's a lot of risk in there. And we have an illustration that we'll share in the show notes as well from Dimensional Fund Advisors, that the average performance of companies before and after they became one of the 10 largest companies in the US. And before they reach that milestone, performance tends to be really, really strong. And then it tends to be fairly disappointing afterwards, in most cases less than 1% over the next 3, 5, and 10 years. So thinking twice before making those forays into what's been the latest hot stock that you might see in Money Magazine or Fortune, or all your friends and neighbors are talking about at cocktail parties. And then finally, think about, do you need an accountability partner? Change can be hard to make on your own, particularly if you've been following the same pattern for 25, 30 years of moving money in and around based on, cocktail party tips or personal whim, opinions, what businesses you're patronizing at that time, and fear. Obviously, fear plays an enormous role.
Yeah, time in the market is one of those instincts that we can tend to have when feelings and emotions start to crop up and influence that decision making. And it's not uncommon for us to try to abandon a plan in circumstances where the waters get a little choppy. That's why if you set the plan beforehand and understand how much safety you need over that next 5 to 7 years, something we talk about a lot in our plans with people, and have put together resources in our ebook you can download to check out of how you can do that beforehand. That gives you some comfort in the risk that you're taking, so you don't have to hit it big with all of these different decisions and the journey that Micheal tried to take there in picking individual stocks, if that was what he was trying to do with his nest egg, right? Because that can be a wild roller coaster to ride and really tough to stay in your seat when you're riding that roller coaster. So we advocate very strongly for putting together a financial plan, because it's not only about your investments. We did dive into that a little more here in this episode, because that's something that's on most either pre-retirees, people looking at retirement, or those that have just retired. That's really on their mind. It becomes a bigger, it takes up more real estate in your head when you are retired, right? Because generally the income isn't there to give you that confidence that it will continue, and you're withdrawing from their portfolio, so that can make you feel a little more nervous. But there's other aspects of the planning approach that can add value over your retirement journey. That's whether it be tax planning, whether it's estate reviews every other year or so, whether it's risk management, how that looks in terms of the insurances that you have. And could be just reviewing your tax return if you've not looked at that side of things. How diversified is your tax buckets in your investment strategy, and can you maximize things with certain lower tax rates? So there's a lot of different areas that we dive into, and putting together those puzzles for people and running different scenarios to give them comfort. But I like this example, and at Halloween we got to have a little fun with things. And so Allison, thank you for putting that together today. I know you had a progress principle. You kind of touched on it a little bit. Do you want to go into that just a little bit to leave people with something as they're thinking about their own investment journey?
Yeah, I think finally, as we see in Michael's story, the comparison that investing can be a lot like a bar of soap. The more you handle it, the less you have over time. So I think that sort of silly little comparison makes a lot of sense when we look back at somebody's investment journey over 40 years. And as you're listening, if you feel like this sounds familiar, this sounds like things I've done in the past, or things that my family members have done, there's still time to change. So there's still, the power to make those changes, as we saw in Michael's journey. When he made those significant changes and committed to a long-term plan at age 50, he was able to make up a lot of ground. So if you have time before retirement and you're finding that you've had some of these experiences in your past and you're ready to make a change, we'd love to have a conversation.
We're passionate about helping you get to a place where you have peace of mind with your finances. So you can check out many of our articles that we've written, over 500 on our website, different podcasts, videos there as well, if you'd prefer to consume it in that way. And then, of course, if you have another question that you'd like us to address on the show, we're going to start answering some questions on the show separate from just the show topic of the day. So send those along to us. And thanks for joining us today. We'll talk to you again in 2 weeks.
And enjoy the Halloween Ends movie.